Thank you for joining us at this morning's webinar. My name is Conor O'Daly and I work at Pengana. At this morning's webinar, we're going to discuss the Pengana Axiom International Ethical Funds. Should take about 30 minutes and we've got time for Q&A at the end. Just a reminder to enter any questions you have via the tab that you should be able to see at the bottom of your screen. This morning, I'm delighted to be joined by Bradley Amoils, lead PM of the Pengana Axiom International Ethical Funds, a portfolio of dynamic and growing companies undergoing positive change at a rate that we believe to be stronger than the market has anticipated. And Bradley is going to discuss how we analyse and position these investments in the portfolio. This investment strategy is available in a currency hedged and unhedged version. Zenith and SQM have reaffirmed the ratings on the funds that we had previously, so recommended and superior respectively. And Lonsec have actually upgraded their rating on the fund from investment grade to recommended, which we were delighted but not surprised to receive. Not dissimilar to Pengana, Axiom is a culture-first organization where the process has delivered extremely strong returns and outperformance for investors since the business was founded in 1998 and since the inception of this investment strategy in 2004. And I'm really looking forward to hearing how Bradley discusses how they've been able to deliver that over an extremely long period of time repeatedly. So a reminder again, please do ask questions as we move through the slides. You'll be able to do so at the bottom, and we'll get to as many of those as we can at the end of the webinar. But without further ado, Bradley, over to you.
Yeah, good morning. Thanks, Connor, and great to be with all of you, joining you from New York. As you heard, Axiom Investments is a boutique, very client-focused investment organization that was established by my partner, Andrew Jacobson, over 2 decades ago. And at the core of what we do is one consistent approach, one consistent philosophy across all our strategies. Importantly, it's a fundamental bottom-up philosophy, but it is really real time. We're able to focus on positive change in a forward-looking manner that is really empirical and transparent, and something that really, when our clients get to know us, is integral to what we do. If we take a look at the first slide, essentially our process involves this very holistic philosophy, and a little later I'll discuss the background of my partner Andrew and myself. This process has been very forward-looking and has proven over many decades to be able to navigate multiple market conditions and has yielded net of fee outperformance across all our strategies, be they this global implementation, be they our emerging markets or our small cap implementation, or our cornerstone international equity, non-US equity that was founded by my partner, Andrew Jacobson, nearly 25 years ago. The team is very experienced. We're a very seasoned bunch of folks. We've been together for many decades. Andrew and I have been together for nearly 20 years. And that really means when you buy Axiom, you're buying this collaborative approach of a very thoughtful and experienced team of managers that are very tenured and very stable at our organization. In terms of the overall organization, we manage about just shy of $20 billion in US assets. And this global strategy is about just shy of $4 billion. I will spend a little more time taking you through that. Also interesting to you folks is about 40% of our assets originate in non-US investors. Folks like you people in Australia, sovereign wealth funds around the world, and basically across all the continents. And that really is important to us, and we're really focused on being aligned with our investors and delivering dynamic performance for them in a thoughtful, risk-adjusted fashion. Finally, we're employee-owned, 100% employee-owned with 25 equity partners across the organization. The partnership extends beyond the investment team to the client service across the breadth of our organization, and really allows us to be focused on picking stocks and outperforming for our clients in a very risk-adjusted manner. And finally, because we're all aligned, it really means that the employees across all the spectrum, certainly all the portfolio people, really reinvest and are very tied to the long-term performance of our products, which really has yielded great results for the group. In terms of the next page, I'm really going to spend a little time now talking about our team. So Andrew and myself both have a science medical background. I grew up in South Africa. You probably get the accent eventually, and studied medicine originally, then went on to business school at Columbia University. Similarly, Andrew had a very congruent background. He studied molecular biology at Princeton, then went on to Wharton to business school. And really why I'm beginning the departure discussion around that is really at the core of what we do is this very empirical, deep process that really is data-driven. It's fundamental, but it really is at the core of what all 8 portfolio managers and our entire research team of roughly 24 sector research associates and research analysts really embrace and execute along. And that really is at the heart of what we do. We're seeking to invest in dynamic companies that are changing for the better and where that good news is not in the share price. And really what that means is 3 key tenets of what we do. The largest component is positive change. 60% of what drives us to a stock is an operational real-time data point, be it, the new product introduction, a price hike, a new management. They can be macro or micro. They can be a real-time data point like a TSA throughput, something very topical as the US opens their borders today. And those really are the catalysts and the genesis of our stock ideas, and really rest 60+% of the investment thesis on those. The next component of what we do is 20%, which is sustainability. And we're really looking to invest in these high quality businesses where the other investors, be it the buy side or the sell side, and even management really are anchored on a growth rate decelerating. And we can find real-time criteria that will show us and give us conviction that this growth investment is more sustainable than is embedded in a detailed set of forecasts that we appraise and survey in our work. And then finally, the final 20% of what we do is really a comprehensive analysis of valuation work. We really want to be focused on that 60% positive change, that 20% duration and sustainability of the growth, but we really do not want to have to overpay for that. And that really acts as a cross-check and a balance that confirms and helps us collaborate and calibrate our risk assessment. And that really comes to the next slide, which really talks about what we do as a group. And the entire team at Axiom is focused on this process of assigning a number and a letter ranking on each discrete security that we own, and certainly any securities that we're considering buying. And integral to this is a number ranking 1 through 3 that really scores the dynamism that I was talking about earlier. And as you can see, a 0 is a stock that's marginally within a margin of error of expectations. A 1 is 3 to 10% ahead, a 2, 10 to 20, and the 3 and above is 20+% ahead of expectations. And then in addition to that, we have a risk ranking that's a synthesis of many metrics that really assigns the stock a letter categorization between A and E. And then we position the stocks on this grid. Importantly, really a couple of takeaways. First of all, you will see that the preference is for dynamism. I mentioned that our desire is to have 60% positive change. So what you can see on this grid is you can see incrementally a stock that moves from a 2 to a 3 or a 1 to a 2 gets an incremental capital allocation of 100 basis points. And that's really key. That really means that our desire for dynamism is reflected in how we build the portfolio. This portfolio, you can see really has the shaded area, which are the stocks that fall within our target zone. Those are the companies that are good enough for us to own and consider owning in each of the disciplines. It's a very holistic incorporation of this 4-step process: idea generation, fundamental analysis. This grid really drives the 3rd step, which is the portfolio construction. And as you can see, the optimal stock for us would be that large mega cap global champion, an A3, where things are 20+% ahead of expectations, where that's not reflected in valuations. It tends to be rare, but when we find those, you can see the target zone. We would allocate at least 4%, and that's sort of the zone, to those positions. Conversely, we find very many niche stocks, which I'll talk about a couple of stocks a little later, that are very dynamic, exhibiting profound positive change with sustainability and moderate valuations. And those tend to be companies that really can excel, can provide active alpha, and really outperform for us. So stepping back from this grid, you could say that there's an efficient frontier running from A1 through to E3, and those are the stocks we want to own. On the other hand, what this tool does, particularly using our Axware, which is a way of monitoring and adjusting this data flow of news and information, we're able to actively size the portfolios with the freshest information and be sure that we're not anchored in past experience, we're not anchored in backward-looking data, and we're really reflecting the newest, most salient information in how we build the portfolios, which stocks we're adding to, and which stocks we're moving away from. And that really is the critical tool and allows us to optimize our portfolio construction and build a dynamic, risk-adjusted group of about 45 to 65 stocks in this global universe. It's very holistic. It includes both macro and micro, and a bunch of key factors that really embrace a deep fundamental analysis, including governance, environmental and social factors that really allow us to build this portfolio in an ethical and prudent fashion for investors like yourselves. In terms of this particular implementation, as you can see on the next slide, we really focus on a dozen exclusion criteria that appropriately limit a very few amount of stocks that we would have traditionally made their way through our dynamic gap, our positive change, and importantly, really allows us to work and deliver this alpha within an ethical framework. More importantly for us, it's really about the change. So really, we are very active investors. We're very engaged with the companies, with the management. We get deep in the dialogue around ESG factors. We're deep in the voting policy and engagement. And really for us at the margin, it's about how these ESG factors are improving and changing for the better, and how we can engage and transparently publish our voting information, our engagement activity, and these are things that really are at the heart of what we do. They certainly have been implemented across multiple decades, and really now are just the added framework of these dozen or so exclusion criteria really just provides an additional implementation of this process. I'm really going to pause for a moment now and just really talk to you now about this Pengana Axiom Global Equity Strategy. It's really been very successful. If you page forward, you'll see up in US dollars for this discipline that we have been running for nearly 20 years. There are some adjustments made as it's been converted to AUD with the Pengana fee structure overlaid. So that's why that has to say simulated. but it's absolutely real results that we've delivered through many markets, through rotations, through bull and bear markets. And broadly speaking, the philosophy and the discipline has resulted in, a bull market upside capture of about 1.5 times and a down market capture of just under 100%. And that's resulted in these very attractive risk return criteria in an all cap implementation of this dynamic growth approach. As I understand, everybody is really focused on markets right now and on some very bold returns over the last 1 year, 3 years, particularly in the growth space. So I really thought I would bring a couple of slides to life. We spend a lot of time tracking data at Axiom. We use our Axware system to score data, and broadly speaking, we score fundamental data for both macro and micro. We score it on the macro side in 3 broad buckets, and I thought we would show you some of this. We scored the data for growth, inflation, and balance sheet. And really what I thought I would share today was some of our real-time data going forward even till the end of October. And as you can see, our Axware, this is a derivation of it, really tries to score data in a color-coded manner, green being good and red being bad. So for inflation, we've reversed the magnitude. If inflation's high, we'll score it with a minus and it'll be red. Conversely, if growth is good and very dynamic, we'll score it with a plus and it'll be boldly in green. Really, as we all are so acutely aware and reading in the press every day right now, front and center is the focus on growth, inflation, and the cadence of a market where nominal growth, is the best it's been in multiple decades, and where inflation, on the other hand, is as high as it's been in 30 years, with data like CPI flirting with 7-8% in some countries, and the core CPI flirting with 5%. So for us, really, we've distilled this data down to, as you can see, the different geographies. We like to score the data for all the regions and then aggregate it for the world. And what you can obviously see in the first block is really that the cadence of growth around the world is tracking very positive. We're obviously all aware of the reacceleration and all the stimulus that has been placed in our financial system. And that really is being reflected with positive growth pretty much across the globe, other than some signs of slowing in Latin America more recently, and to some smaller degree in China. On the other hand, inflation is clearly abundant. One only needs to read the papers and read headlines about, used car prices being up 25%. And that clearly, is something we're concerned about. However, we continue to track it. We continue to monitor how things are tracking versus a detailed survey across all the geographies of the economists' forecasts. And as you can see, at the margin, there's been a slight cooling off of the inflationary pressures. We're all aware about the supply chain bottlenecks and some of the acute squeezes in things like electrical power in China. But importantly, really, we're starting to see at the margin some of the commodities rolling over, some of the barometers for the bottlenecks in freight, like the Baltic freight, beginning to at least show signs of abating, and the second derivatives of these slowing. So at the margin, really, we're seeing that inflation is clearly a problem. Our data is showing that potentially it could be, abating to some small degree. Clearly, transient is lasting longer than people expected. But for us, really, the outlook for growth with and more importantly for our companies is looking very positive, and we feel confident that particularly our companies that are stepping over this bar and producing positive surprise where we don't have to overpay for it really provide a very good backdrop for our investors, particularly in this ethical fund. And I thought, considering that, and I would spend a few minutes chatting about a couple of stock examples, some of which may be well known to you, some of which may be more in the niche type of companies that are less well known. And I really wanted to illustrate these and chat to you about a couple of names. Tesla obviously is in the news, and we probably can wait for questions on that one. But it's a stock that's been a huge winner for Axiom, a stock that we embraced over 2 years ago, where the dynamic gap, the combination of operating criteria such as delivering on cars, on price point, at the targets, at the times that were required, and having financial measures of cash flow, balance sheet improvements commensurate with that, really made that a stock we could embrace about 2 years ago. It ranked up as a B2 and has been a very successful holding for us at Axiom, and one that we continue to see significant upside based on the medium-term performance of their new factories and them stepping over the operational and investor threshold, not being that the stock has done extremely well for us. Another name worth talking about would be Moderna. Moderna has been a holding for around about 3 to 4 quarters now. It was a name that we got into early this year when expectations around the rollout of the vaccine were very moderate, and where people really did not realize the potential of the company and their earnings power. And a name that has ranked up very dynamic for us, was at times it floated between a B2 and a B3, was one of the largest, and actually the largest position in the portfolio, but has now been dramatically moderated. And those two names, because I'm familiar with and very aware of what they do. But I really thought that, in order to articulate what we at Axiom do and how we're different, I'd spend a couple of minutes talking about two of the other companies that are core to what we do. One is a B. It's just falls in the large but not mega cap space, and is a company called Generac. And that's a stock that we've owned across the Axiom portfolios. We collaborate as a group, and our small cap folks have owned this stock for around about 4 years. But importantly, this was a name that's been embraced by the global portfolios around about 2.5, 3 years ago. What Generac does is they make supplemental standby home generators that really benefit from people installing these in their homes, with a very low penetration in the US of less than 5% of supplemental home generators. We embraced the stock with a combination of an increase in climatic events, where we were getting a bi-coastal weather phenomenon of storms on the East Coast and fires on the West Coast, and a very clear picture that this business was going to be way more dynamic than people expected, step over the threshold in terms of sales forecasts and cash flows. And as a stock that has doubled and quadrupled their capacity for producing generators, has been very successful in adding incremental home energy storage devices and energy management, things like thermostats and efficient control of the energy usage within a home, and has really shown demonstrable dynamic gap, but more importantly, a great sustainability in terms of the addressable market and how well this company can do for a longer period. And so that's been an important and successful holding for the portfolios over the last 2 years. And then finally, I'll talk to Copart. Copart, again, a niche business that has been effectively, this is a company that focuses on reselling damaged automobiles that have been involved in accidents. And really, the operating drivers that got us excited about this business were a partnership with one of the large insurance companies, Geico, and the potential to really accelerate and build a platform around selling used and wrecked car components in a very effective manner. in the end, this business landed up being able to outgrow by twofold an expectation of about an 8 or 9% market, which comprises GDP, incremental accidents, and incremental wrecking of cars as automobiles have more sensors and automobiles are considered scrapped in 20% of the cases of accidents now versus 10% a decade or so ago. And it's proven to be a very successful niche platform that has been able to grow and double sales over the course of the 2 or so years we owned it through the COVID cycle, and really shown how our process can find these interesting, niche companies where the growth is very underappreciated. I'm going to pause here for a few moments and see what questions there are. And
great. Thanks, Bradley. Give you a moment to catch your breath. Some great insights. And as per usual, we've had lots of questions come through, which I'll try group together to make as much sense of them as possible. The first one I'll actually tackle, which is a question around the fair value estimate of the fund and how it can be assessed. So the both funds, the hedged and unhedged funds, are unlisted managed funds. They're priced daily, so you can apply to invest in these funds on a daily basis, and you can redeem on a daily basis, and that's done at the net asset value of the fund, which is the real price. So there's no fair value estimate required to invest in these strategies. The price we publish is the real price of those listed investments. So Bradley, the next one is for you, and it's roughly based around the US. And if I could summarize it as best I can, so where do you see the outlook for US earnings going forward? And based off the latest reporting cycle that we've just had, is there any key insights that the team are taking out of that to build portfolios?
Sure. So, for us, again, we're building bottom-up portfolios focused on this dynamic gap with 60% positive change, 20% sustainability, and a 20% focus on appropriate valuations. But clearly, markets are driven by earnings. We're coming towards the tail end of the S&P earnings for this quarter. We've had over 90% of companies report, and really some phenomenally stunning characteristics in terms of the earnings season in aggregate. Certainly, many of the cyclical companies have delivered, enormous upside as they've recovered from the niders of COVID. But importantly, in aggregate, we really can explain a lot of this movement in the markets by the headline sales and earnings growth. So earnings are up nearly 42% year on year for the S&P 500, and sales are up, nearly 20%, 19 odd percent. So those are very profound numbers, and really, provide a backdrop for an understanding as to, markets are clearly not cheap. Markets are trading around about 21 or 22 times forward earnings. But really, one can see that we're in an exceptional period for growth right now. Our focus is on growth. If you take a look, my partner did a presentation coming on nearly a year and a half, 2 years ago. We really believe that the environment right now is very suited to growth because there is such an absence of growth driven by what we like to call the 4Ds, which broadly begin with the demographic changes in the world where populations are demonstrably not growing other than some continents like Africa. And that provides a dearth of growth and is very supportive for what we do. In addition, this environment where debt is enormous, but interest rates are going to stay lower for longer, at least in terms of the longer term scale of where interest rates have been. And then finally, we have two other components. The world has become less globally integrated. We're disaggregating some of the supply chains, and to some degree, we're deglobalizing our trade links, and that really has created less growth for some of the emerging markets. And then finally, the final and key D, disruption. all these disruptive technologies and platforms that form the foundation of many of the positive change genesis that we're seeing in our stocks we're owning is really very supportive for the companies that we own, the type of businesses that we embrace. So notwithstanding, big moves in the market, but really very attractive results in terms of aggregate earnings for the S&P in particular that we've just come to the end of this quarter. We continue to really be able to cherry pick, around about 45 stocks in this discipline and continue to be confident that these companies will step over the bar and grow into their valuations and deliver in a risk-adjusted fashion positive alpha for our clients.
Great. Next question is, so we saw the negative screens through the slide deck, and we can see from the track record that you've been able to deliver for clients that investing ethically doesn't mean you have to forego a source of return, which some people have assumed over time. But maybe if you could give us a couple of minutes discussing how ESG is also integrated in your investment process, because you've been quite focused on ESG since the inception of the business and making sure that that's integrated in how you look at companies. Sure,
absolutely. Really, our ESG is synonymous with digging deep into the fundamentals of the business. And we've always focused on a very holistic approach to scoring the enterprises. And for us, really, the critical component of it is the magnitude and the pace of change. So for us, we're really looking at ESG within the framework of, how management are addressing issues around governance, around sustainability, and around energy management, and how they're portraying it, how we were able to engage with them, discuss the more contentious matters. And in the end, our point of reference is nothing is static. And for us, the most important component of the ESG is where they will be moving forward in a couple of quarters and certainly a year or two. And that really is at the heart of how we embrace it, how we engage with the companies, how we vote our proxies, and how we publish reports on the various enterprises that we have been proactive with in engaging with.
Great, thanks. Bradley, we've pretty much all but ran out of time this morning. There are a few questions that we haven't got to. Myself or a member of the team shall give you a call or an email just to answer those. One thing I would like to point out is we are in the process of reopening the strategy across a range of investment platforms. And I know in some instances, there are some investors and advisors who are still finding some difficulty getting access to the strategy. If that is the case, please do reach out to us and let us know, and we will be working very hard with you to get those reopened where we can. But if we don't know about it, it's a bit more difficult for us to do so. This webinar has been recorded. Please do feel free to share it with your client base and colleagues. You should receive a copy of it later on this afternoon. And this and many more material is available at pengana.com. And for now, I'd just like to thank you for joining us. Thank you, Bradley, for your time, and speak to you soon.